Something doesn't add up. I've been watching markets for years, and what I'm seeing right now makes less sense than anything I've witnessed before. The patterns have broken, the old rules don't apply, and most people investing their retirement savings have no idea what they're actually participating in. Last month, news broke that would have crashed markets a decade ago. Tariffs threatening global trade, employment data showing weakness, geopolitical tensions escalating, the kind of headlines that send rational investors running for safety. Markets dropped for about a day, then they recovered, then they hit new all-time highs again. The month before that, different bad news, same pattern, drop, recover, new highs. The month before that, same thing, and the month before that. I started keeping track. Major negative development after major negative development, each one causing a brief decline, each decline followed by a rally that exceeded the previous peak, over and over and over. This pattern has trained an entire generation of investors to expect that every decline will be temporary, that bad news doesn't really matter, that the market only goes up eventually regardless of what happens in the actual world. And this expectation might be the most dangerous thing in finance right now, because something fundamental has changed in how markets work, and most people don't understand what's actually driving the prices they're depending on for their futures. Today I'm going to show you what's actually happening beneath the surface, why the market behaves the way it does despite conditions that should produce different results, what risks are building that most investors don't see, and what this means for anyone trying to build wealth in an environment that no longer operates by traditional rules. This isn't doom and gloom. It's not prediction of imminent collapse. It's something more important. Understanding what you're actually participating in when you invest your money in today's markets. Because if you don't understand what's really happening, you can't make informed decisions about your own financial future. And uninformed decisions in environments like this one tend to produce painful results. Let me show you what's actually going on. The disconnect between markets and reality has grown to proportions that should concern anyone paying attention. On one side of the equation, stock indexes are reaching historic highs. The S&P 500 continues climbing. Portfolio balances look strong. The numbers on retirement account statements create feelings of progress and security. On the other side of the equation, household financial pressure is intensifying. Consumer debt has reached levels never seen before. Credit card balances are at all-time highs. People are borrowing to cover basic expenses in ways that indicate genuine distress. These two realities don't fit together under traditional market logic. Stock prices are supposed to reflect the health of the economy. When consumers are healthy, they spend. When they spend, companies profit. When companies profit, stock prices rise. The linkage is supposed to flow from economic reality to market valuation. But what we're seeing is stock prices rising while consumer health deteriorates. The economy that underlies corporate profits is showing strain. Yet the prices that should reflect that strain are ignoring it. I talked to a financial advisor recently who expressed the same confusion. His clients' portfolios look better than ever. Their daily lives feel more stressed than ever. They're simultaneously richer on paper and more financially anxious in practice. The contradiction doesn't make sense to them. It doesn't make sense because what's driving markets isn't primarily economic fundamentals anymore. It's something else. Something most investors don't understand because they haven't studied how the game changed. The game changed during the pandemic and hasn't changed back. When economic activity collapsed during lockdowns, the Federal Reserve responded with unprecedented action. The central bank injected massive liquidity into the financial system. Not modest amounts, trillions of dollars created and deployed in months. This liquidity injection served a purpose. It prevented financial system collapse. It supported asset prices during a genuine economic emergency. It did what it was designed to do in the short term, but that liquidity didn't disappear when the emergency passed. It stayed in the financial system. It found its way into asset prices. It inflated stocks, real estate, and other investments in ways that persisted long after the emergency ended. The surge in asset prices that occurred wasn't because the economy became incredibly productive. It was because enormous amounts of money entered the system and needed somewhere to go. That money flowed into financial assets and pushed prices higher. This is the first thing most investors don't understand. The market gains of recent years came substantially from money creation, not from corresponding economic improvement. The prices rose because the currency units used to measure them multiplied. Understanding this matters because it changes how you interpret current prices. If prices rose because of economic progress, they reflect something real and sustainable. If prices rose because of money creation, they reflect something different, a monetary phenomenon more than an economic one. The distinction affects everything about how to think about markets going forward. Inflation revealed what the money creation actually did. Printing currency doesn't create wealth, it redistributes wealth. When trillions of new dollars entered the economy, each existing dollar became worth less. The increased money supply chasing the same amount of goods and services meant higher prices for those goods and services. This is exactly what happened. Inflation surged to levels not seen in decades. The cost of everything increased: groceries, housing, transportation, healthcare. Every category of spending rose as the additional currency worked through the system. Most households experienced this as declining purchasing power. Their wages increased somewhat, but not as fast as their expenses increased. The gap between income and outgo narrowed or reversed. Financial stress increased even for households that nominally earned more than before. But here's what many people miss. Asset owners experienced this period differently than wage earners. If you owned assets before the money printing occurred, those assets inflated along with everything else. Your stocks rose, your real estate rose, your investments increased in value. The inflation that hurt your purchasing power at the grocery store helped your portfolio statement. If you relied primarily on wages without significant assets, you experienced mostly the negative side: higher costs without corresponding asset appreciation. Your labor bought less while you had no portfolio gains to offset the loss. This is how the pandemic recovery created such uneven outcomes. The same monetary policy that produced record stock prices also produced record financial stress. The same force that enriched investors impoverished wage earners. The divergence wasn't coincidental, it was mechanical. The wealth inequality that widened after the pandemic wasn't random. It was the direct result of how the monetary system responded to crisis and who benefited from that response versus who paid the costs. Central bank policy then attempted to address the inflation it had created. After inflation became impossible to ignore, the Federal Reserve reversed course. Instead of injecting liquidity, it began withdrawing it. Interest rates rose dramatically. The money supply began contracting instead of expanding. This tightening policy did slow inflation. The rate of price increases declined from peak levels. The immediate crisis of runaway inflation was contained. But tightening policy doesn't reverse earlier price increases. It only slows future ones. The prices that rose during the inflationary period stayed high. They just stopped rising as quickly. Many households discovered this painful reality. Inflation slowed, but prices didn't fall. The grocery bill remained elevated. The rent remained elevated. The financial strain created by the inflationary surge remained even as inflation rates declined. Meanwhile, the tightening policy that slowed inflation also threatened asset prices. Higher interest rates make borrowing more expensive. They reduce the present value of future earnings. They should, according to traditional logic, push stock prices down. Yet the market adapted. It found reasons to keep rising despite conditions that should have constrained it. The pattern of bad news followed by new highs continued even during supposed tightening. This is where things become particularly confusing for traditional analysis. By late 2024 and into 2025, policy shifted again. The commitment to tightening gave way to renewed stimulus. Liquidity began flowing back into markets. The brief experiment with normalization ended before normalization was achieved. This pattern of attempted tightening followed by resumed easing has repeated across multiple cycles. Each time inflation becomes problematic, authorities attempt to withdraw support. Each time withdrawal threatens markets or economic stability, authorities resume support. The market has learned this pattern. Investors have learned that threats to withdraw liquidity are temporary, while commitments to provide it are durable. This expectation drives the behavior where every decline becomes a buying opportunity because experience has taught that support will return. Understanding this dynamic explains the otherwise inexplicable market behavior. Prices ignore bad news because prices have been trained by repeated experience that bad news triggers policy support. The worse things get, the more likely intervention becomes. downside becomes limited by expected policy response. This creates a market that behaves rationally given the rules it operates under, even if those rules seem disconnected from economic fundamentals. Something else has changed that most investors haven't noticed. Government is no longer merely a regulator of financial markets. It has become an active participant in them. Historically, government's relationship with markets involved setting rules, enforcing them, and occasionally intervening during crises. Government stood outside the market, overseeing it rather than playing in it. This relationship has shifted. Policymakers now allocate public funds directly into specific industries and companies. Government has become an investor, choosing winners and directing capital flows. The stated rationale involves competitiveness and security. Domestic production capabilities have atrophied in certain sectors. Dependence on foreign supply chains creates vulnerability. Strategic industries require support to develop or maintain. These concerns are legitimate, but the method of addressing them transforms how markets function. Strategic investments now target specific sectors. Semiconductor manufacturing receives billions in public funding. Rare earth mining and processing receives support. Battery technology and lithium production receives investment. Artificial intelligence development receives prioritization. These aren't broad economic policies that affect everyone equally. They're targeted interventions that favor specific companies, specific industries, specific technologies. Government is picking winners rather than letting market competition determine outcomes. For investors, this creates a fundamentally different environment than the one traditional investment theory assumes. Traditional theory assumes market prices reflect the collective wisdom of many independent actors evaluating business fundamentals. Supply and demand from many buyers and sellers produces prices that efficiently incorporate available information. But when the largest, most powerful actor in any market is government, and government makes decisions based on political and strategic considerations rather than business fundamentals, market prices reflect something different. They reflect which businesses have government support rather than which businesses have the best fundamentals. This changes what it means to analyze investments. Understanding policy becomes as important as understanding business. Knowing which sectors government is supporting matters as much as knowing which sectors have the best economics. Individual investors don't have the same access to policy information that institutions and insiders have. They don't have lobbyists providing early warning of policy shifts. They don't have relationships with officials making allocation decisions. They compete against players who have structural advantages they cannot match. The playing field that was never truly level has become even more tilted. The government participation in markets that was supposed to help everyone actually helps some participants far more than others. Something equally important has changed about the structure of diversification itself. Many investors believe they're diversified because they own index funds that hold hundreds of companies. The S&P 500 includes 500 separate businesses. Owning all of them seems like spreading risk widely. This belief no longer reflects reality. The structure of the index has changed dramatically. A small number of extremely large companies now dominate the total value. The concentration has reached levels not seen in decades. The 7 largest companies in the index, mostly technology giants, represent a massive share of total market capitalization. Some estimates suggest these 7 companies alone account for nearly a third of the entire index's value. This means that owning the S&P 500 isn't really owning 500 companies equally. It's owning 7 companies heavily and 493 companies lightly. The performance of those 7 companies determines the performance of the index far more than the other 493 combined. These 7 are primarily technology companies involved in artificial intelligence, cloud computing, and digital infrastructure. They're all exposed to similar technological and regulatory risks. They tend to move together during market stress. What appears to be diversification is actually concentration disguised as diversification. The investor who believes they've spread risk widely has actually concentrated risk in a small group of correlated companies. If these few dominant companies experience significant declines, the entire index would fall substantially regardless of how the other 493 perform. The apparent safety of owning the broad market doesn't provide the protection that the concept of diversification is supposed to provide. Most passive investors have no idea this concentration exists. They set up automatic contributions to index funds, assuming they're building balanced portfolios. They don't realize they're making concentrated bets on a handful of technology giants. This isn't necessarily wrong. Those technology giants might continue performing well, but it's important to know what you actually own rather than what you think you own. The mismatch between perception and reality creates risk that informed decision-making requires understanding. The growth that has driven recent market performance came primarily from these few companies. If you removed the top performers from the index, the remaining 490-plus companies produced modest results. The headline gains that made investors feel wealthy came from enormous appreciation in a small number of holdings. This concentration of gains creates fragility. The market appears strong because of a narrow leadership. If that leadership falters, the market appearance changes dramatically. Previous market periods have seen similar concentration followed by painful corrections. The technology bubble of the late 1990s featured extreme concentration in a small number of stocks that subsequently collapsed. The pattern doesn't always repeat exactly, but concentration has historically preceded volatility. I'm not predicting collapse. I'm noting that the apparent strength is narrower than it appears. The security that broad index ownership is supposed to provide isn't as broad as the name suggests. Understanding this helps calibrate actual risk exposure. Many things could disrupt the current arrangement. The technology giants that drive market performance face regulatory scrutiny in multiple jurisdictions, antitrust concerns, privacy regulations, content moderation requirements, national security considerations. Any of these could affect operations and valuations. The artificial intelligence theme that has justified recent valuations might not deliver expected returns on investment. The companies spending billions on AI infrastructure need to convert that spending into profits. If returns disappoint, valuations built on AI expectations could deflate. The monetary support that has backstopped markets might face constraints. Inflation could resurge if stimulus returns too aggressively. Political changes could shift central bank priorities. International currency competition could limit American monetary freedom. None of these are predictions. They're possibilities that reasonable analysis acknowledges. The market that seems to only go up exists in an environment where many things could change. Despite everything I've described, I'm not suggesting avoiding markets entirely. Long-term investing still matters because long-term asset prices have historically trended upward. Through world wars, depressions, financial crises, and every other challenge, patient investors holding diversified assets over decades have generally been rewarded. This long-term tendency doesn't guarantee any specific period will produce positive returns. It provides context that extreme pessimism and complete withdrawal are also risky strategies. Missing market participation entirely means missing growth that has historically occurred. The person who stayed out of markets during the past decade avoided some volatility, but also missed enormous gains. The person who panics out during declines often misses the recoveries that follow. The key is understanding rather than either naive optimism or fearful avoidance. Knowing what you actually own, knowing what forces drive the prices, knowing the risks you're actually taking rather than the risks you imagine you're taking. Informed participation differs from blind participation. Both involve owning assets, but one involves understanding what those assets are and why they move, while the other involves hoping everything works out without knowing what you're actually doing. Everything I've described is why financial knowledge has become more important than ever. The investment landscape that previous generations navigated was simpler. Buy stocks and hold them. The companies would grow, the economy would expand, patient investors would be rewarded. Today's landscape involves understanding central bank policy, government industrial strategy, market concentration dynamics, inflation mechanics, and geopolitical influences on supply chains. The complexity has increased dramatically. Investors who don't understand these factors make decisions without knowing what influences the outcomes. They're passengers in a vehicle they don't control, hoping the driver knows where to go. Understanding policy decisions allows anticipating potential market impacts. When central banks signal direction changes, informed investors can consider positioning implications. When government announces strategic investments in certain sectors, informed investors can evaluate what that means for different holdings. Understanding economic trends helps interpret market movements. When employment data disappoints, Informed investors understand whether that makes stimulus more likely or signals genuine weakness. Context changes, meaning understanding market structure, like the concentration I described, helps calibrate actual risk exposure. The investor who knows they're concentrated in 7 technology companies can choose whether to adjust or accept that concentration consciously. Educated investors are more likely to protect and grow their wealth because they make decisions based on understanding rather than emotion or ignorance. Political changes could add additional complexity in coming years. Some policymakers are discussing fundamental restructuring of how the government raises revenue. Proposals exist to reduce or eliminate income taxes while replacing that revenue with tariffs on imported goods. If implemented, such changes would dramatically alter economic incentives. They would affect consumer prices for imported goods. They would affect competitive dynamics between domestic and foreign producers. They would affect corporate profitability in various industries differently. The market implications of such shifts would be substantial. Companies dependent on imported inputs would face higher costs. Companies competing against imports would gain advantages. The relative valuations of different sectors would need to adjust. Whether such proposals actually become policy remains uncertain. Political systems produce many proposals that never become reality. But the possibility of significant structural change adds another dimension of uncertainty to the investment environment. Navigating uncertainty requires strategies different from navigating stability. Diversification matters more when potential outcomes span wider ranges. Flexibility to adjust matters more when conditions may shift unexpectedly. The volatility that unsettles many investors can create opportunity for those who understand what's happening. Market movements that feel chaotic often reflect logical responses to changing conditions. The movements feel chaotic because most observers don't understand the conditions driving them. To those who understand, the movements make more sense. Economic uncertainty and policy changes produce large price movements. Some of those movements overshoot in both directions. Fear drives prices below reasonable values. Greed drives prices above reasonable values. The overshoots create opportunities for investors who can identify when prices have diverged from reasonable assessments. This doesn't mean timing markets precisely. That's extremely difficult and probably impossible to do consistently. It means recognizing when general sentiment has become extremely negative or positive relative to underlying conditions. Understanding the forces shaping markets helps investors adapt rather than panic. When you understand why prices moved, you can evaluate whether the move was justified or excessive. When you don't understand, every move triggers anxiety because you can't assess its meaning. The current environment rewards understanding more than previous environments because the current environment is more complex. The investor who takes time to learn how things actually work has greater advantage over the investor who doesn't than in simpler periods. Let me bring together what I've shared and what it means for you. The stock market is behaving strangely because the forces driving it have changed. Central bank policy provides a floor under prices that didn't exist historically. Government has become a market participant picking winners rather than just a referee. Market structure is concentrated so that broad indices aren't actually broad. These changes don't make markets worthless or inevitably doomed. They make markets different from what traditional education taught. Understanding the differences enables better navigation. The disconnect between financial market performance and economic reality for average households reflects the mechanics I described. Asset inflation benefits asset owners. Consumer inflation harms wage earners. The same policies produce both effects, creating divergence rather than unity. The wealth inequality that widened after the pandemic wasn't random misfortune. It was the predictable outcome of how the system responded to crisis. Those positioned to benefit from that response did benefit. Those not positioned paid the costs. Going forward, several things seem likely, though not certain. Policy support for markets will probably continue in some form, because the political costs of letting markets collapse significantly are high. This doesn't mean prices always rise, but means structural support exists that limits how far they can fall before intervention occurs. Concentration. In a small number of large companies will probably continue until something disrupts it. The dynamics that created concentration tend to reinforce themselves. Disruption could come from regulatory action, competitive innovation, or valuation exhaustion, but the timing is unpredictable. The complexity of influences on markets will probably increase rather than decrease. Government involvement will probably deepen. Global competition will probably intensify. Technology shifts will probably accelerate. Navigating this complexity will require ongoing learning rather than set-and-forget approaches. For your actual decisions, several implications follow. Know what you actually own. If you hold index funds, understand that you're concentrated in the largest companies. Decide whether you accept that concentration consciously or want to adjust it. Understand the policy environment. Pay attention to central bank signals. Note government investment priorities. These factors influence market performance more than many traditional fundamentals. Maintain appropriate time horizon. Long-term investing works over decades even through volatile periods. But understanding volatility helps you avoid panic selling that locks in losses. Diversify thoughtfully. Traditional diversification across the S&P 500 doesn't provide what it used to. Consider whether international exposure, different asset classes, or alternative strategies provide balance that domestic large-cap stocks alone no longer provide. Keep learning. The environment changes. What works now might not work later. Staying informed allows adapting to new conditions rather than being surprised by them. Build financial resilience beyond investments. Emergency funds, controlled expenses, multiple income sources if possible. Market volatility is easier to weather when your daily life doesn't depend on portfolio values. The market isn't broken, but it's not operating by the rules most people learned. Understanding the new rules helps you navigate the new environment. Something is different about the stock market. The difference isn't that markets are rigged against you. The difference is that multiple forces now influence prices that didn't influence them historically, or didn't influence them as strongly. Understanding those forces provides advantage that confusion cannot match. The people who will navigate this environment successfully are those who take time to understand what's actually happening. Not those who assume everything is fine because prices keep rising. Not those who assume everything is doomed because conditions seem unstable. Those who understand enough to make informed choices about their own positions. Write in the comments what aspects of current market behavior confuse you most. What doesn't make sense that you'd like to understand better? Sometimes articulating the confusion begins the path toward clarity. Share this with someone who invests for retirement without understanding the forces affecting their accounts. They deserve to know what's actually happening with their money, even if the information is more complex than simple optimism or pessimism would suggest. The market isn't going to announce that things have changed. The headlines will continue reporting new highs and brief declines, and new highs again. The patterns will continue until they don't. Understanding what underlies those patterns is how you prepare for whatever comes next. Because something will come next. Markets never stay the same forever. The current arrangement will evolve into something else eventually. Being prepared for that evolution means understanding today's reality well enough to recognize when it changes. That understanding starts with acknowledging that something is different about how markets work now. Now you know what's different. What you do with that knowledge shapes your financial future. Choose wisely.